Your credit score might be dropping right now, and you have no idea why. 7 mistakes are quietly destroying American credit scores every single day, and almost nobody realizes they're making them. By the end of this video, you'll know exactly what's hurting your score and exactly how to fix it. Let's start with mistake number 1. Mistake number 1 is maxing out your credit utilization. Here's what nobody explains clearly. Your credit utilization ratio, how much of your available credit you're actually using, makes up nearly 30% of your entire credit score calculation. If you have a $5,000 limit and you're carrying a $4,000 balance, that's 80% utilization. Anything above 30% starts hurting you, and above 50% can tank your score fast. Most people think as long as they pay the minimum, they're fine. They're not. The credit bureaus don't care if you pay on time. They care how much of your available credit you're using at the moment your statement closes. This is why some people pay their card off in full every month and still see their score lower than expected. The snapshot the bureau sees might catch you at a high balance moment, even if you cleared it days later. The fix is simple but powerful. Try to keep your utilization under 30% on every single card, not just your overall average. Some experts even recommend under 10% if you're trying to optimize aggressively. You can also ask for a credit limit increase without using it, which automatically lowers your utilization ratio overnight. Mistake number 2 is closing old credit cards. This feels responsible. You're not using that card anymore, so why keep it open? But closing an old card can actually hurt your score in 2 specific ways. First, it reduces your total available credit, which instantly increases your utilization ratio across your remaining cards. Second, and this one surprises people, it can shorten your average account age, which is another factor bureaus track closely. Length of credit history matters more than people realize. If your oldest card is 10 years old and you close it, your average account age drops significantly, especially if your other cards are newer. The bureaus reward longevity and stability. A card sitting and used in your drawer for years is actually helping your score just by existing. The fix here is counterintuitive but effective. Keep old cards open even if you rarely use them. Put one small recurring subscription on it like a streaming service and set up autopay. This keeps the account active without you having to think about it, while preserving your credit history and your available credit limit. Now mistake number 3, which catches almost everyone off guard. Applying for too many cards in a short period. Every time you apply for credit, the lender pulls what's called a hard inquiry. One hard inquiry barely moves your score, but several inquiries in a short window signal something concerning to lenders. It tells them you might be desperate for credit, possibly because you're in financial trouble. Banks call this credit-seeking behavior, and it's treated as a red flag. Each hard inquiry can knock off a few points individually, but the real damage comes from the pattern. 5 inquiries in 2 months looks very different to a lender than 5 inquiries spread across 5 years. If you're planning a major purchase, like a house or a car, avoid applying for new credit cards for at least 6 months beforehand. Lenders pull your report right before closing. Mistake number 4 is paying late, even by just a few days. Most people understand that missing a payment entirely is bad. But here's what catches people off guard. Even being a single day late can trigger a report to the credit bureaus once you cross 30 days past due, and that single mark can stay on your report for up to 7 years. The damage from one late payment can range from 60 to over 100 points, depending on how strong your credit was beforehand. Ironically, people with excellent credit often get hit hardest because they have more points to lose. A single 30-day late payment is treated as a serious red flag by lending algorithms, even if every other payment in your history was perfect. The fix is setting up autopay for at least the minimum payment on every card you own. This doesn't mean you shouldn't pay more when you can, but autopay acts as a safety net, so a forgotten payment never becomes a 30-day late mark. Most banking apps also let you set payment reminders 5 to 7 days before the due date as an extra layer of protection. Mistake number 5 is having no credit mix diversity. This one is less known but still impactful. Credit scoring models like to see that you can responsibly manage different types of credit, not just credit cards. This includes installment loans like car payments or student loans, alongside revolving credit like credit cards. If your entire credit file consists only of credit cards, you're missing out on a small percentage of score optimization that comes from demonstrating mixed credit management. This doesn't mean you should take out unnecessary loans just to diversify. But if you already have a car loan or student loan, keep paying it responsibly, because it's quietly helping your overall credit profile alongside your cards. Mistake number 6 is co-signing or becoming an authorized user carelessly. This one catches families off guard constantly. When you co-sign a loan or credit card for someone, you become equally responsible for that debt in the eyes of the credit bureaus. If they miss a payment, it shows up on your credit report too, even though you might never even know they missed it until your score drops. The same risk applies in reverse if you add someone as an authorized user on your card who isn't financially responsible. Their spending habits can directly impact your utilization ratio and your payment history. Many parents add their adult children as authorized users hoping to help build their credit, not realizing that reckless spending on that shared card hits the parent's score just as hard. Before co-signing or adding anyone to your credit, have an honest conversation about responsibility and set clear expectations, or consider alternatives like becoming a guarantor with limited liability instead, depending on what the lender allows. Mistake number 7, and this might be the most overlooked one: not checking your credit report for errors. Studies have consistently shown that a significant percentage of credit reports contain at least one error, ranging from incorrect account information to payments mistakenly marked late that were actually paid on time. These errors don't fix themselves. The credit bureaus rely on you to notice and dispute them. An account that isn't even yours, a payment marked late due to a processing error, or an old debt that should have been removed years ago can all be quietly dragging your score down without your knowledge. You're entitled to a free credit report from each of the 3 major bureaus, Experian, Equifax, and TransUnion, once a year through the official government-authorized website. Checking this regularly and disputing any errors you find can recover points you didn't even know you were losing. Let's quickly recap all 7 mistakes that could be quietly destroying your credit score. Mistake 1, high credit utilization above 30%. Mistake 2, closing old credit cards and shortening your credit history. Mistake 3, applying for too many cards in a short window. Mistake 4, even a single late payment crossing 30 days. Mistake 5, having no diversity in your credit mix. Mistake 6, co-signing or adding authorized users carelessly. And mistake 7, never checking your credit report for hidden errors. Here's the encouraging part: none of these mistakes are permanent. Credit scores are designed to recover. Someone who fixes their utilization today can see meaningful improvement within just 1 to 2 billing cycles. Someone who disputes an error successfully can see points restored almost immediately once it's corrected. The credit system in America isn't designed to trap you forever. It's designed to reward consistent, responsible behavior over time. The people with excellent credit scores aren't necessarily wealthier or smarter. They simply understand these 7 rules and apply them consistently, month after month, year after year. Start today. Pick just 1 mistake from this list that applies to you right now, and fix it this week. Check your utilization. Set up that autopay. Pull your free credit report. Small actions compound into significant score improvements over just a few months. If this video helped you understand your credit score better, make sure to subscribe, because we break down exactly how American money systems actually work every single day. Drop a comment below telling us which of these 7 mistakes surprised you the most. We read every single one.